Straight into earnings, City Union Bank came out with its quarterly performance. What is the earnings fine print? Mr. N Kamakodi is the MD and CEO now joining us live. Thanks so much for taking time out. I wanted to start off with your growth in advances and deposits. Compared to last quarter, it has seen a growth but still in single digits. So when can we see double-digit growth?
We expect to see that in the current financial year. In fact, during the financial year 23 and 24, there were years of consolidation, and we had to make incremental investment in the technology and introduce digital lending platform and all. The introduction is reaching the final stage, and we are also have created separate verticals for the business development and things like that. And many things are in working progress, which are expected to start giving the results from this year. We hope to see things improving in the current year, and you might have probably seen about 5 to 6% growth on Q basis in the fourth quarter, which is the indication that things should get better in the current financial year.
Right. Mr. Kamakodi, would you have a guidance or an internal target that you've set for yourself for FY25?
Basically, I don't want to give any number, but the whatever we had in the fourth quarter is a very good indication on how things will improve in the current year. Once we cross double-digit figure during the course of the year, we will be in a position to give the exact expectations and the forecast for the current financial year. Last year, at the beginning, we thought, like say, we will be having some growth, and we gave something which we couldn't achieve. And hence, I want to refrain from giving any specific numbers this time, but I have to definitely say that the things have improved, and the numbers are like say, we are able to see good traction, and we will be able to give exact number as we cross a couple of more steps before we give some exact number to move forward.
Sure. Two things, Mr. Kamakodi, that impacted your PPOP this particular quarter: lower other income and higher OPEX as well. What led to this during the quarter, and then what's your outlook for the same? Was there any one-off event?
See, basically, there are two things which you have to keep in mind at this time. One is for other income. Basically, for us, the other income comes from the segments of the core fee income of commission, exchange, brokerage, and fees, and you have treasury profit, and you have write-backs from the return of assets and other miscellaneous income. Basically, for the year as a whole, like if in terms of NPA recoveries, if the recoveries happen in the like technically written off accounts, they get accounted as the other income, and if the recovery happens in the like recovery of the live assets, they get like benefit through the decreased provision. Because of that, this year the much of the recoveries happened through the like live accounts. Hence, the credit cost has come down substantially to 20 basis points, one of our lifetime lows. And hence, the recoveries did not happen in technically written off accounts. It optically makes you to see that the other incomes have come down. So another in terms of the like the other expenses, as I told in the beginning, we have started making investments, particularly on like say building up the sales vertical and all, which like say normally traditional banks, they don't have separate sales vertical. And similarly, like the digital lending implementation and all under process, and there are investments in the these things which are happening. So now the expenditure are taken upfront, and it will take some time for results to be seen, and hence it looks the like say cost factor is increasing to some extent, and the cost to income ratio has for the year also has increased from about less than 40% in like say previous year to about 46-47% for the current year.
Right.
So once these investments start giving the returns,
Yes.
the things will come back to the normal.
Sure. I just wanted to get in a quick word. What is the outlook when it comes to double-digit, your overall asset quality improving, and where do you see provisions headed? A quick call.
So as you have seen the like say more than 5% Q on Q for the fourth quarter, definitely the growth rate for the current year should be much better compared to whatever we had. And once we make some, firm numbers, we will be in a position to give the exact number. And finally, when things come to ROA, you can clearly see things have crossed 1.5%, which is our long-term average. So the things are back on track. And similarly, on asset quality front, the slippages have substantially decreased compared to the previous year. And hence, the overall gross NPA and net NPA have come down, and the credit cost also has come down to our historical lows. So everything is already demonstrated, and the growth is also we are at the verge of seeing. So the year 24-25 should be substantially better than financial year 23-24.
Okay, Mr. Kamakodi, great to have you today on the show. Thank you so much for highlighting your numbers.
If you like this video, then like, share and subscribe to ET Now.